All right, welcome back to News Channel 7 at 4. Those high interest rates and inflation in the housing market just seem to be impacting everybody. Whether you need a place to stay or you've got property, we've got an expert here, though, that will help you today so you know whether there's an end in sight and know what you need to do to make the best decision for yourself about your own housing and your own money. So Alex is here. And Alex, tell them who you are with and what you do.
So my name is Alex Astin. I'm a financial advisor and certified estate planner with a firm called Burns Estate Planning and Wealth Advisors. And we have a couple offices, one in Destin and one in Panama City Beach over here in Florida.
Okay, so you know your stuff. So just establish that he knows his stuff. So he works with money all the time. Okay, so Alex, you had sent me some information that was really interesting. So it looks like inflation rates could go even higher. So I know that there are a couple of things that you right off the bat have said, these are the top things that you can do right now to prepare for that.
Right, so the first one you want to think of is inflation is how much more is my money, or how much less is my money worth than it was a year ago. The last report that we had in September was 8.2%. So if those dollars are not invested making you anything, basically that purchasing power is less 8.2%. So the whole idea is everything costs more, right? Mm-hmm. So if your income is fixed and it's remained the same, well, one thing you want to look at is, well, surely your expenses have risen. So you need to make sure that that income exceeds your expenses and to what extent. And if they don't, you need to adjust. Make sure that those expenses, maybe there's some out there like subscriptions, right? There's subscriptions that people have to even pay attention to, right?
Right.
So look at maybe something like that, reduce your expenses, and that's one way you can get ahead of inflation. Another way, what you need to do is, right, 8.2% is a lot. Mm-hmm. How are you supposed to keep up with that? How is your purchasing power, but be invested? So please, if you can, stay invested if you're not retired. Make sure you have those dollars working for you, because if not, if you're below 59.5, in most circumstances, you'll take a 10% hit if you withdraw from an IRA or 401k or something similar to that. Yeah. And then it counts as income tax as well. So you're adding on there, and you just want to avoid that if you can. Adjust from the top end first, looking at the income and expenses.
Oh, wow. So that's a lot to keep up with. Of course, you know, like you said, compensating for that everything is more expensive. And you mentioned, of course, investing because of all of those taxes.
Yeah, and one thing you want to avoid is making emotional mistakes as well, because people see their portfolio down 25, 30%, depending how you're invested. And one thing you don't want to do is go and sell things at the very low. Right? I've sat with people that sold at market lows in 2008, 2009, and never got back in because it scared them so much, and they missed out on a lot of growth on the upside. So if you are an emotional person and don't want to make those decisions on your own, meet with a financial professional like ourselves who can help you, guide you along this hard time right now.
So one of the big questions, of course, you know, it's great that we know that, you know, some of the things we can do to get through it. When is there going to be an end in sight?
That's a tricky question. And many economists, they range from anywhere 6 months to a year, some even to 2024, because there's stickier parts to inflation than others, right? We're seeing used cars come down. We're seeing housing applications come down. There's certain areas in the market we are seeing deflationary pressure come and set in. The Fed has reiterated their target is to get inflation back to that normal 2% range, and we're way off of that right now. And so it's gonna stick around for a lot longer than I think people assume. And so we need to continue to adjust that balance sheet that we spoke about, but look forward into 2023 being a year where inflation is not increasing, but decreasing at that point. And once we get there, right, then you can readjust that income and those expenses again, and just continuously build that balance sheet. So that way, we're having some really great entry points in the market right now, right? There's a lot of equities and stocks, and depending on your age, right, a lot of things are on sale. And so continuously moving and averaging into the market, long-term scope, it can pay off really well for you.
Good. Well, that's promising to know that, you know, like you said, don't make too many emotional decisions because it will eventually get back to normal, I hope.
Right. You look at, you know, stock market declines. There's plenty of them for a month, 2 months, 6 months. But once you extend yourself out to 18 months to 2 years, there's far and few between. And, you know, we're already almost a year right now where markets peaked November last year. So we're already into it. If you've written it out this far, you know, keep going because there will be an end in sight. I know it doesn't seem like it right now, but ultimately every downturn in the market has always been met with an upturn, and we see that trend obviously continuing.
Music to our ears, Alex. Thank you for letting us know all of that, and thank you so much for taking the time to share that expertise that you have with us.